Hi Louis, thanks for joining us today.
It's my pleasure.
Can I start by asking you about your general investment philosophy? What do you think is fundamental to achieving good and consistent investment outperformance?
For us, in our strategy, it's about investing in companies with persistently high financial productivity, so returns on capital. That's the alpha source. The misconception that we think exists is because the market assumes that these businesses see their returns competed away down to a cost of capital. And the insights that we've got to generate is we've got to identify businesses that have competitive advantages that will enable them to resist that competition.
Right.
To maintain those returns for higher than the market and for longer than the market expects. But actually, I don't think a philosophy is necessary, very necessary, but it's not sufficient on its own. I think you also have to have a very good, rigorous process that allows you to leverage your investment tools and capabilities in order to generate those insights, and to be able to do it in a repeatable way, I think is also really important.
Everyone talks about growth or value investing. There's far less awareness of quality investing. Why do you think is that so?
I completely agree with you that quality does not get the same level of attention that growth and value does. But even if you look at the MSCI style indices, which are for quality, growth and value, it shows really clearly that the only style that has delivered consistent alpha over 20, 30, 40 years is quality. Now, so why doesn't it get the attention? Maybe it's because it's a bit more difficult to define exactly what quality is. Quality can mean different things to different people.
Right.
Some people think of quality as stability, real consistency. Others think of it as the actual level of financial productivity or returns on capital. I'm not really sure, but to tell you the truth, I don't really mind that people aren't so focused on it, actually. We'll stay locked onto it and let other people spend their time thinking about EPS growth and price to book numbers and other things like that. We'll focus on returns on capital.
Yeah, more alpha for you.
Hopefully.
Global Quality Growth has a concentrated portfolio of just 40, 50 stocks. Is this deliberate or simply a question of not being able to find enough companies that fit your criteria?
I wouldn't say it's deliberate. It's certainly not for a lack of opportunities and investment candidates, first off. There's no real science behind the 40 to 50 stocks. It's just the right balance that Barney and I feel that we feel comfortable with in terms of getting the right blend of concentration so that every stock can contribute to clients' returns, but not too much individual risk, not too concentrated a portfolio that prevents you from having a nice diversification across different sources of competitive advantage and therefore different exposures to sectors. And we like to have quite a bit of a balance in the portfolio across sectors, even though there are lots of sectors where we don't invest and the clients shouldn't ever expect us to be present in. Utilities, for example, we don't invest in oil majors, we've zero weight in telecoms, we haven't invested in mining companies. But other than that, 40 to 50 names gives us that opportunity to target different competitive advantages and therefore give the portfolio exposure to different sectors.
Finally, what's your view of where the economy and market is heading, given that we are coming to terms with higher for longer inflation and interest rates?
Well, the first thing I really have to reiterate and stress is that we are bottom-up stock pickers. So we don't build the portfolio from the top down, we build it from the bottom up. And that means we don't take market views, sector views, or macro views. From my personal opinion and where we sit today, I can see really three scenarios, and I'll try and explain how quality stocks we would expect to perform in those. So if inflation stays high where it is at the moment, I think the absolutely critical question that everybody has to ask the companies that they're invested in is, what's your ability to pass on your cost increases that everyone's going to be seeing because of inflation?
Right.
And do you have sufficient pricing power to pass that on to your customers? Because if you don't, you are going to be at real risk of seeing a big contraction in your margins as they get squeezed between your input costs and the prices that you can actually charge your customers. Now, the good news there for quality stocks is that pricing power actually is the hallmark of a high quality business. That's what a competitive advantage should give you. And so we would be very confident in that environment that quality stocks would do much better than the average stock in the market. So that's the first scenario. The second scenario would be if actually inflation starts to roll off and come off somewhat. And then I think that would also be very positive for quality stocks for a different reason, and that is I would expect interest rates to also start to follow that direction of inflation. So you'd expect eventually interest rate cuts to start to come through into the market. And their quality stocks I think would perform very well because they tend to be longer duration than the market, and therefore they are more sensitive to changes in the discount rate, which are ultimately in large part driven by short-term interest rates. And therefore as discount rates fall, quality stocks should be the prices should be more sensitive to that than the overall market and should rise further. The third scenario would be one where inflation actually continues to increase. That would be difficult. That would necessitate probably more interest rate increases than the market expects.
Right.
And when interest rates are rising, discount rates will also be rising, and that initial period I think will be a challenge for quality stocks. It was a challenge for quality stocks in 2022 when interest rates moved from 0 up to wherever they are today. That would be a short-term challenging position to be in, but I think the effect of those significantly higher interest rates from where we are today would really put global growth into real question, would definitely open up the possibility of economies moving into recession as a result of central banks really trying to choke off aggregate demand to quell inflation. And then we've seen quality stocks have historically really protected investors' capital in difficult equity and economic environments.
Thanks very much, Louis. Thanks for joining us.
Pleasure, Dharmo.